If you've clicked on this video, you're probably wondering why some people in Singapore may choose alternate investments like stocks when it comes to building wealth in Singapore. In Singapore, there are two schools of thoughts in terms of how you should use your property to your advantage. One school believes that you should work your way up and buy two condos, one for your own stay and the other for investment. And then there is the other school of thought, which believes in just buying one HDB flat and investing in solid stocks like index funds, letting compounding work its magic. If you want to know which is the better option for you and don't want to risk going down the wrong path, then this is the video for you. By the end of this video, you understand the two different schools of thoughts, where they overlap, what their strengths and weaknesses are in terms of things like barrier to entry, effort, and liquidity, so that you can decide for yourself where you should put your money. The first mindset is a private property mindset. This mindset is built on the belief that property or real estate can be used as a tool to use borrowed money to generate returns. In the case of Singapore real estate, that will entail taking a 75% bank loan, getting the tenant to pay off the mortgage, and eventually selling your condo off at a profit. But this idea doesn't just come from nowhere. To understand why some people believe that real estate is better than stocks, we need to look at who are the key figures who promote this mindset and how they make money through real estate. One of the most prominent non-agent property investors in Singapore is Eric Chew. He emphasizes acquiring residential property, particularly in Singapore. Due to cooling measures and stamp duties, which makes it hard for one Singaporean to own more than one residential property, he advocates for couples to own two, one under the husband's name and one under the wife's name. One to live in and the other one to rent out. From there, they can either stop or upgrade both properties over time. All these are expected to drive asset appreciation. In general, it targets capital gains of about 100k per year, achieved through a smart entry price and careful project and unit selection. To assess whether property or stocks are better, we first need to look at what the capital gains from real estate can potentially look like. In a previous video where we talked about reasons why people never get rich from property in Singapore, we looked at Kovan residents as a positive case study. In this example of Kovan residents, one buyer made a gross profit of over $920,000. After accounting for interest and other costs, his net gain was still around $780,000. Not bad for a 7-year investment. That said, property in Singapore still has very high entry barriers. You need a large down payment, you need to pay stamp duties, and you also take the risk of vacancy. On top of that, you still need to actually manage the property, and that entails dealing with the tenants, repairs, and even things like an interest rate hike. This effort is definitely real, but what about other challenges? Stay till the end where we'll break down how those factors impact individual investors like yourself. Still, this property-first mindset is still considered relatively old school. In the past decade, a new mindset has been gaining some traction, especially among the younger generation and YouTubers. It's a mindset that offers more flexibility and less stress. If you're new here, my name is Daryl, and in this channel, we talk about real estate in Singapore. If you're watching this video, then you're probably interested in real estate investment in Singapore, and may also be interested in some of my other videos which talk about why some people never get rich from their property, some problems with buying a condo to rent out, and what a good investment condo really looks like. The second mindset is a stock or equities or portfolio approach. This mindset generally views equities or stocks as the main way to build your wealth in Singapore. It focuses on things like dollar cost averaging, consistency, automation, and even diversification. It doesn't really reject property outright because in Singapore, you still need a home to stay. But it doesn't see home ownership as essential to getting rich. Instead, it encourages living comfortably in a HDB flat and investing the rest into the stock market. This strategy focuses on building a strong base of stocks, REITs, ETFs, and CPF savings. It prioritizes liquidity and a peace of mind over leverage and debt. When you think of this school of thought, local influencers like Kelvin Learn Investings or Chris at Honey Money SG come to mind. They promote frugal living in a HDB, avoiding excessive debt, and investing in low-cost index funds like the S&P 500. A newer example would be the Contrarian Turtle, a YouTuber who shares his journey to growing a $4.5 million portfolio, all while working a salaried job, staying in a HDB, and investing in index funds. He even coined this very interesting acronym called HEM, HDB, Avoid Car, and Market Index Investing. Because of HDB's lower cost, monthly installments are smaller as well. This reduces the overall financial stress on your monthly salary, which then allows more funds to be channeled into liquid assets or stocks. Overall, this in turn also provides a bit of a peace of mind. But unlike real estate, stocks are actually very volatile. Property prices move and appreciate slower, But stock portfolios can drop 10 to 20% in a single month. Staying invested actually takes a lot of emotional discipline. To fairly compare stocks and property, let's take the same 380k down payment used in our earlier condo example and apply to stocks over the same 7-year period from 2017 to 2024. That stock portfolio would have given you a profit of 586k, assuming no reinvestments. But just because the condo example here made more money than the stock example, that does not mean that condo investments in general are better than stocks. Firstly, we cherry-picked this condo to be a very profitable one. There are many less profitable condos or even condos which may have lost money over this 7-year period. Secondly, the time frame that we used was very specific as well. And that is why it is better to run an apple-to-apple comparison before arriving at any decision. We should factor in things like rental income, interest, historical returns, hidden costs, taxes, and any other details as well. If you want a deep dive quantitative forecast and comparison between condo and the S&P 500, I'm planning on doing one soon. So remember to subscribe if you don't want to miss more such unbiased videos. We've seen that both stocks and real estate can yield some very solid returns, with some differences in terms of how they may affect you personally. So the real question we should be asking ourselves is which is the better one for us, for our risk profile and preferences. So here's the truth. Neither option is inherently right or wrong. Stocks tend to be the lower effort path. There's no physical maintenance required, and the knowledge barrier can be argued to be much lower, especially with the presence of beginner-friendly options like index funds. For example, the S&P 500 allows you to invest in the 500 top US companies with built-in diversification, reducing the risk of bad picks. Stocks also have a much lower entry point. You can start with just a few $100s a month, unlike property, which typically requires a 25% down payment and certain income levels to qualify for a loan. Real estate, on the other hand, stands out for its stability. In Singapore, property prices are generally less volatile than stocks. If you prefer a more stable investment, then this might suit you better. But remember this, it depends a lot on which unit and which project you buy into, and especially your entry price. But real estate also lacks this element of liquidity. It can take you months to sell a condo and even longer to receive your cash after the sale. Unlike stocks, you can't just sell part of your investment. While methods like equity extraction or what we call gearing up does exist, they come with strict requirements around CPF and income and require an ongoing loan repayment after you have extracted your equity. Property in general also costs more to maintain. Think agent fees, condo maintenance, income tax, property tax, and stamp duties. In contrast, stocks usually only require brokerage fees when you buy or sell the stock. If you want to understand the true cost of renting a condo in Singapore, check out my video in the description below. But just because many of the quantitative factors so far are leaning towards stock, that does not mean that property or real estate is a bad investment for you. The bigger question is still this: after factoring all this interest and costs and taxes, can real estate still outperform stocks? I plan to do this comparison in an upcoming video, so remember to like and subscribe. But taking a step back, I think the question of whether stocks or real estate is a better investment comes down to 3 things. The first is which are you personally more knowledgeable about. The second is what kind of financial lifestyle do you want. And the third is which is better aligned to your financial goals and situation. If you understand property, have the capital, and don't mind managing a physical unit, then it can actually be a powerful tool as you'll demonstrate in a subsequent video. Otherwise, stocks are also a very solid and less stressful alternative. I tried to think of this comparison from all the possible unbiased and different angles, but if you feel that I missed anything out, feel free to call it out in the comment section below. The key here isn't trying to choose which is the so-called better option. It is choosing the one that you understand more, are comfortable with, and can commit to in the long term. And of course, thanks to all the YouTubers for sharing their journeys and insights regarding stocks and real estate. I hope I haven't misquoted anybody, but if you think I missed any of the nuances, feel free to let me know below it. Otherwise, I'll link their channels in the description below as well. Let me know in the comment section below which of the 2 paths you're leaning more towards. The less stressful but maybe more volatile stocks option, or the less liquid but more stable real estate option. If you happen to be leaning towards a property investment path, then check out my next video which talks about what makes an investment condo so profitable.